In this video, we will be looking at weighted average cost of capital, also known as WACC. We'll look at the WACC equation, components of WACC, what opportunity costs are, how opportunity costs are related to WACC, and a walkthrough example using Excel. The weighted average cost of capital is a hurdle rate or an expected return. Some uses include discount rates, so they gauge the minimum return required as a percent, or projects measure profitability using cash flows that result in a net present value. So net present value is used as an indicator to go forward with a project or investment. So if net present value is greater than the project cost, then we can expect that the investment will turn a positive return. And this is the WACC equation written out, and we will go over that now. So this is the equational form. So E is the market value of the firm's equity. So this is the shares outstanding and the market price per share. And then D, as indicated above here, is the market value of the firm's debt. So this is using the market value bonds equation, or also known as the time value of money, which we've gone through already. So the components of market value of bonds is a C for coupon rate. So this is the coupon rate times the face value of the bond divided by the periods per year. F is going to be equal to your face value, which in this course is usually $1,000. Your YTM, yield to maturity, is your current market yield divided by your periods per year. Your N is years to maturity times the periods per year. And then bonds usually have a two-year period, so they pay twice a year of interest. And then the debt is a accumulation of any long-term debts. This can be mortgages or notes payable. We could also use book values for these, but it's more desirable to use market value because these is a very market value oriented equation. So to calculate V, or the value, this will be your E, your equity plus your debt, and this will be the value of the firm's capital structure, debt and equity, which you'll go through later on as well. So what is an opportunity cost? So this is the loss or potential gain from another alternative when one alternative is chosen. So for instance, now we're going to go over these R to the subscript E's and R to the subscript D, as well as T subscript C. So R subscript E is the equity. So the opportunity cost of equity is anything that can be bought or invested with equity, such as cash or cash equivalents. To measure this, we use a CAPM model. This is used to gauge the market return on equity. So this is R subscript E equals the risk-free rate, so treasury bonds. Beta is the volatility of investments like this and others. And R subscript M is the average return in the market. These can all be found as for common shares only. So opportunity cost on debt, or R subscript D in this equation, which is this part right here. This is the yield to maturity, or the current yield for similar securities of long-term debt held by the firm. So this will be your YTM, the same YTM that you use for the bond market equation. You could also calculate this as the actual interest rate, the actual interest on the current bonds. So this will be your interest of this year and the debt of last year, because you accumulate that interest annually. So this opportunity cost is usually lower than equity due to debt being cheap. This is because we have low interest rates at this time. So this is a firm that can invest equity, i.e. cash, and get a greater return than the costs of debt. So in return, returns higher than the cost of debt. So that is, we're getting a higher rate of return than the cost of debt. So the last part is going to be the T subscript C. This is your corporate tax rate. Under the current tax law, that is the corporate rate national-wide is 20% plus the given state tax for your state. So for Utah, that is 6%. So giving us an effective 26 flat tax rate for this equation. So now we are going to open up the workbook titled WACC example problem. For this example, we'll be using the financials that you used for the accounting section as well as the ratio section. Financials open, we can see that these are the same financials that you used for the accounting section as well as the ratio section, with the exception that bonds are added and these givens are added as well. So the accounting equation still holds true. The assets equal the liabilities plus equity. So we can go through and start plugging in the numbers. So now we're going to do market value of the common equity, which is just going to be your shares outstanding times your share price. And then we can do this for the second year as well, for the year prior. All right, now that we have that, we can do an EPS ratio, which is earnings per share. So this is going to be your net income from that year divided by your shares. And then we can do this for this year as well, for the year prior. All right. And now we got a PE ratio. This is price per earnings. So this is going to be your price at this time divided by your earnings per share. And we can drag that across. Okay, now we're going to come over to our bond area. So our coupon rate is a given, so we're going to take that. We have a YTM current yield, that is also a given. Our PYR is given. Our years are not given, so it is year 224, and these bonds were issued in 2010. So if we were to minus these, 2024 minus from 2010, we get 14 years. Our N is going to be our number per year. So this is going to be our PYR times our years outstanding of 28. Our face value, like we've said for this class, is going to be purely $1,000 increments. Our C is going to be our face value times our coupon rate divided by the 2 periods per year. Make sure these are in brackets. And then we can use the time value of money equation. So we need a present value. So our rate is going to be our yield to maturity divided by 2. For the Excel function, we need to be able to distinguish this. It doesn't understand it's 2 periods per year because this is the yearly rate, so we need to divide it to be on the same rate as our compounding N at 2 periods per year. Our payment is the 25, and our future value is going to be the 1,000. If it'll click. Okay. So that's a negative number, so money's coming out. So we can change this by putting a negative before that. All right. So we know that we need to calculate how many bonds there are. So we can see that we have a bond of $1,000, a bond value of book value. So that tells us that there is one bond that was bought. So we can go 1. So if we were to times our market value of a bond times our number of bonds on the balance sheet, we have a bond value of $1,234 35 cents. All right. So again, our cost of debt is just our current yield, so we can bring that on over. Our cost of equity using the CAPM model is going to be our risk-free rate, so right here, plus parenthesis our beta, parenthesis again, our market minus the free, and then double parentheses. Oh, we forgot our times. All right, now that we have all the information figured out, we can just plug it on in here. All right, so our market price for common is going to be that 35 for our common shares. Our debt is this bond value, our market value for bonds, plus the loan value that's on the books. So this is long term, so we need all long-term debt. So if we sum these together, so this one plus this one, we get that. So $1,600 and $825. So $1,825. So now we gotta get our weights. So this is a weighted average. And then this divided by the total gives us 100%. And this should equal 100% as well, as you can see down here, 100%. Now it is time to calculate WACC. So all you need to do is we have our weighted averages already calculated here. So we just take that weight average times our CAPM, and then we add that to this, the debt, or RD, and then we times that by the cost of debt, and we times this by 1 minus the tax rate. Let's make sure all of the parentheses are needed in the equation, and it would seem we do. And that is how we calculate WACC.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.